In other business news, some analysts say South Africa's financial pandemic is not all doom and gloom. That says investment opportunities still exist, allowing room for diversification and improvement of one's portfolios. Head of Retail Investments at Nedbank, Sisandile, Cikido, joins us to further this discussion. Thank you so much for your time, as we'll be speaking about the positive side of this economic climate. Let's first really talk about the offerings that exist in this current climate when it comes to investment opportunities, portfolios and vehicles that consumers can tap into.
Good morning, and good morning to the newsroom viewers. Thank you for having me. I think in these times when we hear things like interest rate hikes, we get really nervous, and rightfully so, because it means generally that we're going to be paying more on our any kind of debt, that is, on all our higher purchase sort of debt. And that also means, however, that there is a little bit more that you can earn in terms of your investments. And so this is the time to really have a look at what it is that you're looking to do, whether it is long-term savings and investing or just saving for a goal, and then really have a look at what is at your disposal and ensure that your portfolio, which is what we're going to be chatting about, is diversified and has various sort of instruments to get you to those goals.
How far can one diversify given the constraints of the struggling consumer's pocket? And if we're talking about investment, of course, it can either be a short or a long game, but the latter is preferred. What would you advise for somebody who is new in the block of investing and doing it for the first time as a young entrant in the economic participation of South Africa, and it happens to take place in a climate that is precarious?
So first of all, I'd say seek advice. The first thing you need to do is have a look at what is available, what is on offer by different service providers, but seek advice. Seek advice from a registered financial planner to assist you in setting up those long-term, medium-term, and short-term goals. But I would say first, get started. Start somewhere and ensure that you're doing something different and doing something every time your salary increases. Make sure that you're allocating a little bit more to your savings and investments goals. A lot of young people think retirement is very far away. A lot of people in their 30s think retirement is very far away, but we know that we've got to start today. So if you're looking at sort of long-term investments, look into retirement annuities, look into various sort of different portfolio diversifications, whether it is your unit trusts, whether it's ETFs and shares, and knowing that you're going to play the long haul. And also have a look at your tax-free investments, which really allow you to earn interest without having to pay any taxes on those interests in the long run. And then it's important to also have a proverbial rainy day, which we saw come to pass with COVID-19 and the lockdowns, where some people couldn't earn income, and they had to take care of other people, they had to take care of more people in their households, take care of family members, as well as take salary cuts. And in those moments is when people who had savings were able to dip into that little bit of a cushion that they had put aside by spending less on a monthly basis and allocating a little bit more to their savings.
Yeah, some of the buzz in terms of trends that we've seen in recent years have been those exchange-traded funds along with the tax-free savings funds. Having that mix becomes quite vital, particularly for one who's starting out. What's to be said about the role of retail savings bonds? They haven't been popular in the last couple of years.
So I think what absolutely needs to happen when you're looking at your savings portfolio, you need to look at, firstly, where are you in your life stage, right? If you're starting out and you have a good 20 to 30 years to invest, you're probably more agile and able to put your money into riskier sort of instruments. So it's okay for you to play the long haul. It's okay for you to be a little bit riskier. But if you're looking at approaching retirement or in your late 40s or in your late 50s, you're probably going to be a little bit more cautious. So it's very important to look at where you are and how much time you have, because a lot of investments actually need more time, and the more aggressive you're going to be, the more time you're going to need to give it. So a lot of individuals will look at retail savings deposits or retail deposits as a little bit of a nest egg and a cushion where you know that your money money is a little bit safer, where if I put in a certain amount of capital, I'm going to get that capital back with interest for sure. I will not lose that money. So if I take my money and I put it in a term deposit account, whether it's between 1 and 60 months, at the end of that term, I'm going to get exactly what I put in plus the interest rate that has been promised. Now, a lot of people would say the interest rate there is marginal. It's not necessarily going to shift the dial a lot in your life. But you also, like I said, have to diversify. You have to look at what it is you're trying to achieve. So a lot of individuals are looking to live off of their savings, live off of their fixed deposit investments, for instance. And that interest that they're able to earn on a monthly, quarterly, or annual basis is how they actually pay for their everyday lifestyle. So it's important to have a view of what it is that you're able to afford, what it is that you're able to afford to lose, and how much time you're able to afford in terms of how risky you want to go. So the retail deposits are far safer because your capital is guaranteed.
Lastly, is there a good or a bad time to even begin investing? And I ask this solely because of the current economic climate.
I would say no. There's never a bad time to start investing. I think every individual needs to do their homework. I think even if you do have advice, please do put in some time in terms of looking at the solutions if they're right for you. I have clients all the time coming to me and saying, I didn't want to put my money away for 60 months. Yes, I wanted the rate, but I wasn't aware that I'd have to pay penalties if I wanted to take my money out. And yes, you're able to benefit from a high interest rate cycle right now if you fix your investment, but it does also mean that you can't get your money out. So I think it's important for you to look at what's available and look at your needs, but it's never, ever the wrong or a bad time to start. I think if you haven't started yet, you aren't too late, but you do need to start right now, whether it is saving for your investments, saving for a holiday, saving for school fees, or just really putting money away to say, I want to live a better life in the next 20 years. The time is now to start. And I think it's important for us to look at our debt to income ratio, look at what it is that you're spending on your debt, how much you can put towards that in order to pay less on your debt and to channel more towards saving and investing for your future.
Thank you for your contribution. Sisandile Cikido is with Nedbank this morning talking to us about investing in tough times.